Hey, good morning, everyone. Marty Mazzora here. It is the 30th of December, 2024. Happy New Year to you all. Hope you had a great Christmas. This morning, I am actually going to wrap up our year-end message right here and now via video, obviously. And I want to do that by touching on the dollar. As I have said to many of you clients, in the review meetings, and I've talked about it a lot on the blog, we have a thesis that says the dollar is going to be weaker on a trend basis in the next cycle. And I emphasize that every single time and tell you that we are still in the current cycle, although I think we are very, very late stage. Now, if this current cycle plays out much like past cycles, it'll play out with some pain, potentially a recession. In a recession, particularly a global recession, the US dollar tends to do well because as the world gets nervous and scared or panics, they buy US treasuries because they are still the safe haven or the safest haven among currencies or among securities that you can own today. You can argue on behalf of gold. And gold does tend to do well. Gold will be a good hedge as well. And I think gold has some properties going forward relative to our long-term thesis that are going to make it a very important thing to continue to own going forward. But the focus I want to close this year with is indeed on the dollar. I already hit that to a pretty good degree in the last, I think it was part 3 of the year-end message, where I talked about our bullishness on non-U.S. securities going forward. So I'm going to reemphasize that with a 40-year chart here in a second and just more or less summarize, again, what you're going to be reading or what you have read by the time you get to this. And you'll note that the quotes in the beginning, this is just pure coincidence. Yesterday I was watching last week's Market Huddle podcast, and I would recommend, by the way, that those of you who are interested in getting deeper in the weeds, watch it. It was a very good one. It's about an hour and 20 minutes, I think. And in the first paragraph above where it says last week's episode, you can click on that and you'll get that on YouTube. But in the first part, I talk about what I'm calling the December mess for the stock market. Now, I did illustrate that in the charts of the day here last week. Essentially, Patrick Ceresna, one of the co-hosts, says you can basically see that there's been a monstrous bear market that's already underway. I think that's an exaggeration, but everything has been getting creamed in December except for that small, concentrated group of tech stocks, the Magnificent Sevens, as they call it. It's a little more than 7 at this point, but it's a very, very concentrated group. You take that out of the S&P, and the S&P really hasn't done much this year. The equal weight, I think, after today is going to be up merely single digits on the year. It's been all about tech. It's a concerning setup. I lived through the 90s. I actually started my career in 1984, so I got to see everything since then and studied virtually everything previous to that. And as I've reiterated for a long time now, this market's going to take a lot of patience to shake out. There's too many characteristics of the bubbly kind of market we had in the late 90s, not entirely. Better companies overall than just all the slew of .coms that went to zero back then, but many, many similarities from a valuation standpoint. Hot new technology that's getting billions of capital investment without really much thought to how we're going to turn that into profitability in the near term. This is kind of the boom and bust of technologies all the way back to when we had canals transferring goods across the country. Talked about that as well. I've referenced a really good book here recently, The Engines That Drive Markets. It's one of my better reads of this last year. I recommend that highly to people who really want to get into the weeds of this stuff. Essentially what that book talks about is the fact that since the beginning of time, every technology that's world-changing or life-changing gets massive amounts of capital investment, then it busts. And the winners do change the world going forward, and they're the places to invest, but you got to live through the busts along the way. In our view, AI hadn't had that bust yet. So again, feels like the dot-com era. Doesn't mean that we're going to have an 80% decline in AI stocks like we did tech. During the tech bubble burst, it was a 50% decline just in the overall S&P. Of course, we don't know how this is going to shake out, if it's going to even shake out like that at all. I will say, as I've been preaching, that we now live in an era of populism, and it's going to take us into many years going forward. And then in that sort of era, you really have to take care of the wealth inequality that's been developed. It's at all-time records now, the income inequality, and you really got to take care of people from a political and a policy perspective when they're hurting. COVID was the test that passed with flying colors. They bailed out the financial sector again. They even broke the rules of the Federal Reserve Act and bought junk bonds. We didn't anticipate that. But then they threw $5 or $6 trillion at the consumer. They weren't going to let them crash and burn like, say, many of them did during 2008. So, folks, get ready, because that's the zeitgeist going forward. We're going to see government step into markets quicker. We're going to see them step into, in a positive way, consumers' pockets quicker. And they're going to try to alleviate as much pain for the consumer as they can. Maybe even the consumer first over markets and over rich folks. If that's the case, that really bolsters our inflation thesis long term. We think it'll be structurally higher inflation, and we do think the dollar is going to be weaker. So you just read some of that logic as to why we think the dollar will be weaker going forward. I provided a link to last year's longer essay on the dollar. If you'd like to get in those weeds again, please go ahead and read that. So back to the quotes that I mentioned, and then Kevin Muir said, yes, these are terrible looking charts, and the amazing part about it, it's the vast majority of the market. So like I illustrated a week or so ago, the S&P equal weight was down 6% in December. I think it's taken back, must be at least 30%, if not 40% of the gains. This morning, it's down 1.75%. So it's falling to the ground rather quickly to end the year. And the S&P itself was only down like 1.5%. The NASDAQ 100 index was still up like 1.5%, where the NASDAQ 100 equal weight index was down like mid-single digits. Now the NASDAQ this morning is down about 2%. So today, at least, the market is selling the tech stocks with both fists, if you will. Now, let's put today into context. It is the day before New Year's Eve. Lots of folks are out skiing. They're on vacation. A lot of Wall Street people are not sitting at their desks today. So, folks, it's these low volume, call them low liquidity days or periods where the market can do dramatic things in either direction. If suddenly there's a bearish short-term bent and people say, heck, I'm just going to get the heck out of this thing right now and just call it a year. Well, if there's nobody at the desks or nobody inclined to get in front of that, then that selling is not going to be met with any bids, right? I mean, it's got to find a buyer at some level. And if there's not a lot of liquidity and there's not a lot of people, manning their desks right now who might otherwise buy, well, then it's going to go down and it's going to create an opportunity for the bulls, tomorrow or after the first of the year. There is perhaps the setup for a pretty ugly January. And notice I said perhaps because of the concerns that we've had. Maybe the market is finally getting the signal after a couple of ridiculous years in these Magnificent Seven stocks, 2 or 3 of those ridiculous years. May very well be a time to sell those. Now the question is that going to bring the rest of the market down? It is today. The S&P equal weight, as I mentioned, is down 1 2/3%. So it's not like there's a lot of rotation into other things. So clients, I guess the good news, and I say that with some hesitation, is that just looking at our core allocation, which many of you, if not most of you, that's what you're allocated to. Some of you have some legacy assets, some things in your non-retirement accounts that didn't want to pay taxes on because of the massive capital gains. Maybe it's a little worse than this, but our core allocation is down 0.5% today. And as I speak, the Dow is down almost 700 points, which is a little better than 1.5%. The S&P equal weight, as I mentioned, is down 1 2/3%. The NASDAQ is down close to 2%. Small caps are down close to 2%, so on. What's working for us is our hedges, of course. The S&P 500 puts are having a good day, so that's mitigating a chunk of the decline. Our nat gas position, it's a stock, is up 3%. Our ag commodities position is up 2%. Our long-term treasuries are up 0.9%. The yen is up 0.5%. I think the yen's going to be a big position for us long-term going forward. We're not big in size there just yet, but that's something we may be adding to soon. Emerging market bonds are up 1/3%, and so on. And then we have the gold is down about 0.5%. We do have a hedge on that, so that's mitigating that a little bit. So while the majority of our positions are down, folks, you can see that, as I just suggested, we've got a handful that are up a bunch today. That is the beauty of a diversified portfolio. You're going to have a frustrating year like we did this year, where it looks like the market's going to the sky, but it's that stuff that's just too expensive and too far out over its skis that our way of looking at the world just doesn't allow us to go there enough to capture that. And again, clients, you know exactly what I'm talking about. Okay, so to cut to the chase and to finish this up for this year and to get focused on next year and how we're going to manage that, let's take a look at the chart in front of you. The top panel is the dollar index going back 40 years. And what I want to illustrate for you here today is how asset classes tend to move relative to the dollar over longer periods of time. So as you can see right up here, the dollar peaked big time back in February of 1985. So what I did is I tracked from the peak to the next recession how well these things have done. Okay, and I'm going to start with U.S. equities, and actually, let's pull this further. Right there, about the same. Okay, so during this big decline to the next recession, U.S. equities actually rose by 123%. And I'm going to take one period at a time. Foreign equities, developed market equities, which would be not your emerging markets, but your non-U.S. developed economies, up, call it triple that, 321% as the dollar declined. Okay. Emerging market equities, this particular index from Morgan Stanley began here, further on during this period here. So, but in that very short period of time, as the dollar was going down, emerging markets were up 155%. Gold was up just 22%, and the Bloomberg Commodity Index was up, call it 24%. Okay, so falling U.S. dollar wasn't bearish for U.S. stocks, but it was incredibly bullish for non-U.S. stocks, developed markets, and emerging markets. Okay, so the next period, right, we have, and I'm just going to pull these back down again, we have the dollar rising. Okay, so this was the 90s, and you can see, at least from these 2 points here, before it began to roll over right before the recession, I could pull that down a little bit, but let's just call it to the peak. A 300% return for U.S. stocks. A third of that result in non-U.S. developed markets, roughly the same in emerging markets. Gold was down 27% during that period, and commodities were flat, up 18% during all those years. Okay, so bear with me here. Kind of clunky how I'm doing this, but hopefully I'm making it clear this way. So then we had the period between the two bubbles, the tech bubble and the real estate bubble. Clients, those of you who've been with us that long may recall that was a really good time for us because of our global allocation. But U.S. stocks did nothing, 32% during that whole time, right, which is an average of 5% a year. Non-U.S. developed markets were up 124%. Emerging markets were up 304% as the dollar was dropping. Gold was up almost 200%, and the Bloomberg Commodity Index was up like 100%. Now we're going to go all the way back to the end of the real estate bubble burst to current, because COVID and that populist reaction to COVID, essentially we had a blip. It was like almost 40% for the Dow. but it was fixed with $11 trillion of fiscal and monetary stimulus. So let's just give them credit for averting what was going to be what we thought would have been a disastrous recession before we could spell COVID, as I like to say. But the powers that be juiced it and saved it. Hence, we have, we think, a bubble right now. Okay, so from this period to the current, almost a 500% move in U.S. stocks. Well, that's great if that's all you owned, and if lately all you owned were those tech stocks. Only 55% for non-U.S. equities, right? 22% for all those years for emerging market equities. 168% for gold, but that's just been happening right now. And I think that's in anticipation of what we're talking about around the dollar and around the global setup. It's also what I wrote about. It is indeed foreign central banks diversifying away from the dollar and into the one thing that's good in all currencies, and that would be gold. And then the Bloomberg Commodity Index actually down 27% during that period. So folks, I'm just going to go back and leverage the two smart guys on the Market Huddle podcast and summarize this with their summary of the dollar. Kevin Muir, eventually the U.S. dollar is going to be for sale. Whether it's this month or next, I don't know, but this is a big long-term top. I could not agree more. And by the way, not all of my friends and colleagues, and certainly not all of the experts, agree with that, which makes me even more optimistic, by the way. You know how it is to be in the consensus, what have you. Patrick Seresna, in the next couple of years, a massive U.S. dollar bear market will be one of the biggest macro moves. And by the way, folks, as you know, I didn't get this from them. This is our own analysis. This is our own research. This is just something I watched yesterday. I thought, wow, they're definitely on our page, or we're on their page, however you want to say that. It'll be a huge commodity bull cycle, driving all sorts of different things. But what'll be interesting is that it wouldn't shock me if it were the halfway through 2025, if we're there and we're still waiting for the transition. I do believe it will happen. I do believe you're going to be right, talking to his co-host. I just don't believe it's going to come as fast as you think it is. Right now, today, the dollar is actually up a little bit, a third of a point. Doesn't seem to matter. It's definitely not helping U.S. stocks. And I've said, by the way, when I show the dollar charts, we get to a point where this becomes very problematic for U.S. stocks. So it's not helping anything. And despite that, our nat gas position is up a bunch, and our ag commodity positions are up a bunch. That speaks to weather, geopolitics, what have you. So folks, here's the thing. As for stocks, and we're a little better than 50% stocks in our core, we seem to be mitigating the lion's share of the declines on the down days, which is the best you can do. So the goal here is to not try to guess what the market's going to do tomorrow, equities, what have you, commodities, U.S., foreign, what have you, in terms of equities, or bonds. The goal here is to do a lot of work on the macro setup globally, various risk-reward setups across asset classes, long-term trends, and be willing to not capture all of the upside of a market that is so incredibly concentrated to the degree that historically when we've gotten here, it's been very problematic as it shakes itself out. In part 3, I said that it would be easy for this market to give back all of the gains and some all the way back to COVID. That's how big, bad bear markets shake out. I do think that the powers that be are going to step into this next one as it develops and try to mitigate it as much as possible. And you could argue that aggressive mitigation attempts could actually freak people out and have them think, oh my God, it's worse than we even thought. So anyway, those are more weeds that we can discuss. Thing to do right now is to stay very diversified, stay liquid, stay hedged, and be in a position, frankly, to take full advantage of this, knowing what we know now about the powers that be and what they're likely to do, knowing what we believe we know about the longer-term setups. Folks, I actually think that this general overall setup from a global macro perspective is incredibly attractive going forward for an extended period of time, but not necessarily today. as I keep saying, this cycle has yet to finish. It's the next cycle I'm talking about. So I want to take this opportunity for you clients out there to express how incredible all of you are. We here at PWA know how blessed we are to be working with such a fabulous group of people. We can't emphasize enough what a pleasure it is and what an honor it is that you have trusted us with your long-term assets. And we promise we do not take that lightly. We will continue to work diligently, dig deep, and do our absolute best to protect your wealth long-term and to grow it appropriately within the right, risk-reward context as we move forward. Folks, again, I wish you all the happiest of New Year's. Going forward, probably stay on the same track where you'll get a couple of blog posts, 2 to 3, when the market's funky. You'll get more, of course. 1 or 2 of those will be a video each week. And again, Happy New Year. It's going to be interesting. And stay tuned. Thanks again. Take care. Bye-bye.